Folks, earnings are finally here. First, we had the COVID-19 vaccine. Then we had the election. Now, earnings are here. And folks, what do we start off? We start off with the financial sector, and the financial sector is making moves. So I want to talk about the broad picture and get into the financial sectors. You may want to get a piece of paper and a pen and write some of these numbers down, because a lot of these numbers are actual expectations. And if the actual number is better than the expectation or worse than the expectation, that can have an impact on the market. So without further ado, let's get into it right now. So for the financial sector, fourth quarter, which is where we're at right now earnings-wise, we're expected to be down 4.8% when it's all said and done on 2.4% lower revenue, which would follow a decline of negative 11.7% in the third quarter of 2020, with 45% negative in second quarter and 32% negative in the first quarter. So the numbers are a lot better than they were last couple of quarters or several quarters. Within the financial sector, banks are still faced with a tough operating environment and are expected to experience 21.4% lower earnings relative to the same period last year, partly offset by earnings growth at the insurance and brokerage money management industries. Keep that in mind. We'll get back to that in a second. For 2020, fourth quarter, S&P 500 as a whole, earnings are expected to be down 9.8% on 0.3% higher revenue, which would follow a 7% earnings decline on third quarter and 0.7% lower revenue. Now, looking at the calendar year picture for the S&P as a whole, earnings are expected to decline 16.4% on 3.8% lower revenue in 2020 and increase 23.1% on 7.6% higher revenue in 2021. Estimates for both years have been going up, which is good. The overall earnings picture started improving in July as the U.S. economy came out of the pandemic-driven slump, while pockets of entrenched weakness remained on pace and magnitude of the recovery has largely been better than expected, even though the more recent data appears to show a moderation in activity levels in response to the ongoing infection surge. Estimates for full year 2021 have gone up as well, but we see significant acceleration in the favorable revisions trends in the coming months on the back of a stronger than expected rebound in consumer and business spending as the ongoing vaccination efforts gains pace and will continue to gain pace. Remember, we've got Pfizer and AstraZeneca coming out in the US in just a few months, and those don't need to be given in two different cycles, and they don't need to be refrigerated, and you don't need to wait 15 minutes afterwards to see if they work. So that's going to make everything faster. We strongly feel that the current estimates for 2021 GDP and earning growth estimates understate the full extent of the rebound, which is positive. Looking at the numbers a bit closer, big banks coming out with notably improved profitability pictures relative to what they were able to show in preceding periods. This is positive. This reconfirms our steady improved earnings outlook that we've been highlighting over the past few months. Now, Goldman Sachs said they just came out this morning, I think. Its profits more than doubled from a year earlier thanks to a surge in trading and advertising revenue. This is not advertising, advising revenue. And that's where the money is right now. It's in trading and advising. Those are the bank stocks that are doing well. Traditional saving and loan stocks are just not doing that great, as you'll see in a second. The New York-based investment bank said it's earned a profit of $4.36 billion, which is $12.08 per share, up from a profit of $1.72 billion or $4.69 per share a year earlier. That's a significant difference. The earnings were significantly better than the $7.45 per share profits that the analysts were expecting. Now, on the opposite end of the horizon, Bank of America's fourth quarter profits fell 18% from a year ago, as lower interest rates weighted down the results. Remember, that's a savings and loan type of bank. However, the bank was able to release more than $800 million from its credit reserve, a sign that it sees the U.S. economy improving in coming months. This scenario is clearly demonstrating that investment banks, as we've anticipated, should continue to outperform traditional savings and loan types of banks for the foreseeable future. The positive bank results aren't just a reflection of business conditions in the last quarter of 2020, but rather a function of optimism about the coming quarter, notwithstanding the elevated infection rates and hiccups on the vaccination front. Now, three major banks, JP Morgan, Wells Fargo, and Citicorp, released more than $5 billion in combined loan loss reserves that they've set aside in the first 3 quarters of the year to cover loans going bad as a result of the pandemic. JP Morgan shares have gained 36%. Citigroup is up 49%. Compared to the S&P 500 that's only gained 9.6% in the quarter, they are smoking the competition. And technically, before I continue, the financial sector as a whole is finally trading above the February of 2020 high, which is very significant. Now, we've got fourth quarter results for 26 S&P 500 members. That's about 5% of the index. Total earnings aggregates for these 26 companies are up about 7.6% from a same period last year on slightly lower revenue, with 96% beating earnings per share and 73% beating estimates. And yes, it's very early. 26 out of 500 doesn't really give us much. Now, for the financial sector, we now have fourth quarter results for about 20% of the sector's market capitalization in the S&P 500. And a big part of the remainder will report in the coming week. That's this week we're in right now. Total earnings for these companies are up about 14.4% from a year ago on slightly lower revenue, with again 96% beating earnings per share. And remember, these earnings per share estimates have been lowered. 73% beating revenue. This is better than expected and better than we've seen from banks in recent quarters, particularly in the first 3 quarters of the year. Looking at the S&P as a whole, growth is expected to resume this year, with the full year 2021 earnings for the S&P 500 expected to be up 22%. Now, estimates for 2021 have been also going steadily up over the last 6 months, and that should cause the stock market to continue moving higher, especially in light of the money that's coming into the market from the Fed via the stimulus and low interest rates. But overall, earnings are looking slightly better than expected. We've got to keep an eye on bank stocks. We've got several of them coming out this week. Again, expect positive, better than expected performance for institutional trading, investment style banks like Morgan Stanley, Goldman Sachs, Merrill Lynch, and expect worse than expected from banks like Wells Fargo, Chase, Bank of America, as you've seen, those that don't have a large institutional investment or advisory division. And I hope that helps. Folks, I'm sure we've all heard that buy and hold strategies are the best way to make money in the markets, right? I mean, come on, we've heard it for years. However, it's simply just not true. In fact, one expert trader just revealed the secret to making triple-digit gains on stocks like Facebook and Apple in as little as 24 hours. No day trading. In on Monday, out on Tuesday, in on Tuesday, out on Wednesday. Stop waiting years for your investment to pay out and start enjoying your returns now. Click on the link below to see how you can get started today.